So Alibaba is going to turn into a bond-like instrument, at least for the next 3 years. Let me explain. So this came right out from the horse's mouth in the most recent earnings call, where Joseph Tsai was essentially outlining how Alibaba as a stock is going to be benefiting shareholder in the upcoming few years. So this actually came at the back of one of the analysts from JP Morgan. He essentially posed this question. Compared to the 2023 calendar year buyback pace, this is a sizable step up. So do you guys have the real serious intention to step up the buyback? Or put it another way, how do you determine the 12 billion buyback per year is the right number to think about? So Joe Tsai, who's the chairman of Alibaba Group, actually provided more color in how they arrive at this number. So I'd like to supplement what Toby said. I'll do a little bit of math on this question. So Toby has said in his prepared remarks that we are targeting a 3 percentage point per year of accretion over the next 3 years through our buyback program. And that commitment is pretty real because if you look at the past 12 months, we actually reduced our share count by 3.3%. So that accretion, we believe, is achievable. And if you look at our share count, we have about 2.5 billion shares outstanding, and 3% is 75 million shares. So Joe Tsai went on to supplement his point. We are anticipating that our stock will increase in price over the next 3 years, and we want to keep our target of 3% accretion per year. So using the $12 billion a year of buyback with rising stock price, I think it is still reasonable to get to 3% a year. And the second part of the equation is 3% accretion a year plus a dividend of $1 per American depository share. The dividend yield at current prices is right around 1.4%. So if you combine the buyback, which is the accretion, and the dividend yield, you are looking at about 4.4 to 4.5%, which is actually quite close to the current 10-year treasury yield. So essentially, that's the math behind how the management team is intending to reward shareholder, at least in the short term. Even if the entire market disagrees with the valuation you think Alibaba should be trading at, share buyback program plus this dividend yield, it's a guaranteed form of return to current shareholders. Now, looking at a few of the key facts. So Alibaba currently has approximately 2.5 billion ADS outstanding. So at an estimation of $70 per share, that makes them trading at right around $175 billion in market cap. So they're targeting a 3% per year accretion over the next 3 years, in addition to the $1 per share dividend. So buyback plus dividend, it's close to the 10-year treasury yield. So these are the key facts being laid out. So on the back of this entire discussion, the management team is essentially implying that, hey, the dividends that we gave out last year, do expect it to come again in the following 3 years. And it is probably true that Alibaba is going to attract a new class of investors, particularly so those that are interested in dividend yield. So for all you Alibaba fans out there, I've got superb news. Poams, who's one of the region's top brokerage firm, is helping you double the happiness as we usher in the Dragon Year of 2024. So you can now unlock exclusive fun and trade rewards when you join Poams as a new user. So you get to enjoy 0 US commission for 90 days, 0% sales charge on your unit trust, and even potentially get free JD and Alibaba shares for new account opening when you fulfill the criteria. So if you make an initial deposit of at least 3,000 Singapore dollars within 14 days of account opening and execute at least 3 buy trades on stocks, ETFs or unit trusts within 90 days, you will get 2 JD shares. So if you qualify for the higher tier where you deposit at least 10,000 Singapore dollars and execute at least 5 buy trades, you'll enjoy 2 JD and on top of that, 2 Alibaba shares. And these free shares are worth up to 280 Singapore dollars. I know many investors are attracted to parking their monies in short-term instruments like money market funds. So Poams currently also allows you to opt into their Smart Park feature, where it's essentially an access fund management facility that invests and manages your idle cash automatically. And the rates updated as of 5th of February is a 7 days annualized yield of 3.72% on your SGD. Not too bad if you're to ask me. So seize this opportunity and enjoy the thrills of doubling the happiness and doubling the prosperity with Poams today. This campaign will end on the 29th of Feb 2024, so don't sleep on this deal. Now, on the second point, this entire share buyback program authorized is sitting at right around 35.3 billion US dollars. So if you divide it by 3, that's around 11.7 billion dollars per year allocated to the buyback. However, let's also not forget that buying back shares is only one part of the equation. The second part of the equation, especially for many of these tech companies, through very sneaky means, they actually issue a lot of shares on the side as well, in terms of share-based compensation. Of course, the good old argument for share-based compensation is that there's an alignment of interests because the remuneration of the employee will be also determined, at least a part of it, based on how the share price has been moving. So essentially, they will have skin in the game. So I'm not against companies that issue shares to employees, but as a shareholder, I just want to know the real impact in terms of the share buyback program. So if I were to backtrack, at least over the last 3 years, I want to understand how much Alibaba has given in terms of share-based compensation. And as you guys know, Alibaba's financial year actually ends on March of every single year. So in order to calculate it on a calendar basis, I have to backtrack and to take two different figures. Number one, it's of course the first quarter, which is the Jan to March quarter. And on number two is the 9 months preceding. So considering the last 3 calendar year, in 2023, Baba issued around $2.67 billion USD in terms of share-based compensation. 2022, they issued around 2.84 billion, and in 2021, they issued 5.11 billion US dollars. Yes, so the 2021 figures is astronomical, and I've went to investigate, and at least based on macro trends, the share outstanding for Alibaba as a company has been on an uptrend all the way until 2020. And only in 2021 can you see the real impact of share-based compensation as they tighten their control in terms of giving out shares and also stepping up their buyback programs. So if we were to aggregate all our data points, let's assume that share-based compensation remains tight between the $2.5 to $2.7 billion range, which was what has happened over the last 2 calendar years, and we net this figure out from the 11.7 billion per year, you can understand that it's essentially a $9 billion per year of real impact in terms of reduction of share count. So if the presumption or the case being argued by the management team is that, hey, we want to achieve a net accretion of 3% per year. So presumably they achieve that target, that's 3% retirement of share outstanding. So management is of the opinion that Baba's market cap should be around $300 billion. Why? Because 9 billion at 3%, 9 divided by 3, that's 3 billion per 1%. Multiply it by 100%, that's $300 billion. So $300 billion in market cap, Alibaba, at least from the management's perspective, should at least be trading at 120 US dollars per share. Leave in the comment section down below, do you think the Alibaba's management team is over-ambitious or they're underscoring their own potential? Now, I think just to paint a fuller picture, so Brandon, who's the CIO of Crane Shares Investment, he recently tweeted back in early Feb of this year that Baba's US dollar bond due later this year has outperformed the stock by not 10, not 20, but 70 freaking percent. It's not a typo. This is beyond absurd. So in the same period, from the 31st of January 2020 to the 1st of February 2024, Baba's US equity has lost a total of negative 65%, while the bond has essentially only lost 7.5%. But let's not forget, the bond actually do issue coupon payments, and the total return profile for the bond is at a positive 6.3%. And looking at the delta or the difference between the bond and the stock, the bond essentially outperformed the stock by 70 freaking percent. So the funny thing is, there's 2 comments in Brenda's tweet here by Zed. So it's not absurd. Credit risk for Alibaba is very low. And I completely agree. In the credit market, nobody is expecting many of these Chinese conglomerates to go bankrupt anytime soon and to default on their payments. And a comment from this user, Live That Beat. You aware that a bond aims a contractual obligation as opposed to a VIE interest, which is whatever. So I kind of get where he's coming from. He's essentially arguing that by having an equity interest in a company that has a very complex structure, particularly so you don't have a real obligation over claiming the profits of the company, you are essentially investing in fairy dust. However, the bond here, you have a particular contract. But that said, if you really think about it intuitively, if you have a contract with a company that has a VIE structure, that technically moots the bond contractual obligation as well, because everything is fairy dust. Now, I think the broader point that we are trying to draw here is really the sentiments around the stock itself and how crazy it seems. But that's it. I think moving forward, with this dividend in place, plus an upsized share buyback program, it kind of acts as some sort of a floor to Alibaba share price. So some other pointers that transpired during the earnings call, I wanted to shed some light on this idea behind the buybacks and the capital control that is installed in China today. So Jiong Sao from Barclays. So I have a question about shareholder return. It's great you increased the buyback by 25 billion, but in terms of the pace of the buyback, we understand there are constraints and limitations such as capital control. So could you talk about the sort of cash you may already have outside of China? What needs to happen for you so that you may be able to pick up the pace of the buyback? So Toby, who's the CFO of Alibaba, has replied, a certain percentage of that cash actually is sitting offshore, which we can use to do the buyback. On the other hand, we also have a good channel to give out the dividends, basically to cash out to offshore that we can further leverage either to make investments in our offshore businesses as well as using those sort of cash to do the buyback. And we can use it if we need it. We can increase the leverage also to sort of get sufficient cash for us to do the share buyback. So on first thought, when you read his response, it definitely doesn't instill confidence. And he kind of seemed like he's trying to hide something. But I think he probably can't say it, but let me try to be the kind of the mouthpiece and try to explain what he's basically saying. Essentially, Alibaba is a central entity. Right now, it's true that there are capital controls installed in China, and they can't really move money easily. But as a central entity, with a credit rating of rather high, because as a Chinese conglomerate, they're still printing a lot of cash, if they really want to benefit shareholder in terms of giving out dividends or buying back shares, buying back overseas shares in fact, they might have limited offshore shares in their balance sheet. So what they can do is essentially leverage up the balance sheet by borrowing in the foreign currency, in this case, whether is it in USD or is it in Hong Kong dollars, lever up the balance sheet and to raise cash and to give it out to shareholders. So in essence, they are essentially moving money from the left pocket to the right pocket. So this is the classic financial engineering, how many of these Wall Street people will move money to kind of skirt around some of these regulations. But this maneuver is essentially a similar concept to the VIE structure, where they try to appease people from both sides of the aisle. And Gary from Morgan Stanley asks, is there any particular focus in terms of markets for the next couple of quarters? And specifically, what is our strategy in the US market given the geopolitical risk ahead of elections? How should we look at the segment loss in the coming quarters? And how are we going to fund the investment between individual financing at the AIDC level versus tapping into the group offshore financing at the group level? Jiang Fan, who is the CEO of Alibaba's International Commerce Group, said that in terms of the local businesses over the past several quarters, we have seen very rapid improvement in efficiency and rapid narrowing of losses. So we look at the efficiency of the investments we have planned to make for our future investments. In terms of the US, we actually do have a business foundation there to consumers and to businesses on Alibaba.com. And his explanation on the losses for the AIDC business. The first is because of the new model, the AliExpress choice model. They have grown very rapidly and now accounts for a very significant percentage of the business overall. At the same time, it's still an early stage business that is still being developed. So as it scales, it's probably going to incur slightly more losses. So the second thing that contributed to the losses this quarter was significant spending on marketing and some major promotions that we did. And thirdly, some investments that we made in Middle East and other key markets. So going forward, he thinks that they'll continue to make large investments in this business, specifically around Choice. We see very clear that Choice is delivering a better user experience and resulting in a much better user retention than the previous model, essentially copying from the Amazon Prime playbook. So these are generally the three key things that I wanted to cover in this video. Alibaba having a bond-like structure, answering the capital control issue in China, and of course, the international growth segment of Alibaba today. So just a few side note, recently, at least based on SoftBank's disclosure, they're really turning Alibaba into Alibaba. They have essentially completely divested from Alibaba to Arm being their largest holding. So you can see this both as a good news and a bad news. The bad news is one of the largest holder of Alibaba has decided to jump ship, especially when the ship is kind of half sunk. On the good news, because the largest shareholder has already exhausted most of the selling pressure. So some of a few additional commentaries. So likewise, on the part 1 of the discussion of Alibaba's recent earnings, there was no new revelation from this report. There was nothing exciting that was revealed. And there were many analysts that was essentially asking about the potential synergies with AI, since it's the golden word today. But Eddie, who's the CEO of Alibaba, just replied, yeah, we do see a lot of potential. And that was essentially the main train of thought. Eddie didn't bang on the table. There was nothing inspiring or hopeful for investors to look forward to. So I guess that's why the share price essentially didn't trade anywhere. The management team currently is also doing a lot of regrouping, disposals of past investments, current investments, looking into IPO, pouring more capital into their business arms, to even financing decision like moving capital around and leveraging the balance sheet to benefit foreign shareholders. So I guess these are some of the key developments in terms of the finance perspective. So I think looking forward for Alibaba, it's going to take time. I think it's not a very quick trade for people to trade in and out. Not barring all these stimulus talks and how China is going to save or resuscitate the entire stock market. But if you look at it on a business fundamentals perspective, many of these maneuvers takes time, and you have to kind of monitor their performances and promises. So they're trying to become more asset light. They're trying to dispose a lot of their investments. They are pushing up their ROIC back to double digits. That's at least the pledge from management team. They're trying to unlock shareholder value, real shareholder value by dividends and share buybacks. And I think one bad thing that transpired over the last few quarters was that investors was essentially brought through this joyride. They talk about wanting to go IPO with Hema, Cai Niao, Ali Cloud, and a lot of these are being squashed because of bad market sentiments, etc., etc. But they didn't really deliver on that perspective. So we really talk about unlocking real shareholder value here. So the China story continues to unfold, which has a natural impact on their numbers because they're ultimately an e-commerce and payments company. So competition is drawing in near, eating away at their lunch, and how they intend to invest and compete. So I think one side note as well is that anything sizable of potential with their ad tools, AI integration, and creating more networks for customers to remain loyal and also consume more, which is the underlying fundamentals of investing into Alibaba in the first place. So I hope you guys enjoyed this discussion, and we'll see you guys in the next video. Goodbye.